Welcome, Samantha, and thanks very much for joining our sixth Future Leaders program, which is looking at how to think more strategically about development finance that supports sustainable production strategies. One of the issues that comes up repeatedly in this space and in your work is that investors' risk perceptions of emerging markets are very important and often quite wrong. Can you tell us a bit more about how this happens and what you think can be done to try to bust some unhelpful myths about investing in emerging markets?
Yeah, this is a really key issue about how investors understand risk, and key to that is data. I'll give you some examples. So if we think around regulation, for example, there is something in European insurance companies are regulated by something called Solvency II. It's just a regulatory framework. And they have to put aside money, if you like, to provide a safety net in the event that things go wrong. And so these are known as capital charges. And these capital charges are estimated based on a level of risk. And because of poor data, basically, the European regulatory authorities, when they were designing this framework, didn't have a lot of good data. And so what we find is that capital charges, i.e. the amount of money that some of these investors have to, if you like, put aside, is very, very high and not actually commensurate with the actual level of risk. And so that was done in about 2016, and about 2018, Moody's released a whole load of data on the credit risk profile of of investment in EMDEs, emerging markets and developing economies. And when they kind of put the numbers through the risk models, what they found actually was a huge disconnect between what's required by the regulators to put aside based on what they think the risk is, and actually based on more newer, better quality data, the charge is actually lower. So in Africa, for example, the charge, they calculated it should be at 4%, but the European regulators requiring 30%. So the key issue here, so it's nearly double, well, more than double. The key issue here is about the availability of data. So as I say, data is a massive issue here, but we have kind of data sources, but the issue is that the Moody's data I referred to basically isn't released regularly, so that is kind of like problematic. But we do have the multilateral development banks and development finance institutions who are like the original impact investors, if you like, in these markets, who have decades of experience of investing, and they have amazing data on the credit risk profiles. But there's been a lot of debate about the kind of how this is shared, if you like, with investors. A lot of debate in the G20. They have a database called GEMS. And maybe people listening, there's been a lot of debate about whether that information is provided in the right form to enable investors to model risk. But anyway, that's improving. And actually, that data does show that actually the level of risk is actually quite low for investing in EMDEs. So for example, for MDB DFI loans over the last 10 years, the default rate has been about 3.3%. So, there is this massive difference between kind of perceived risk and actual risk when you look at the data, but the issue is the quality and availability of data.
That's interesting. There's another theme that, less developed emerging market countries, they often keep a lot of interest rate reserves themselves for a rainy day, and there's a lot of capital held in central banks and reserves that's not used for development finance because of perceived risks of the countries themselves, the macroeconomists and the central bankers in those countries themselves. So there's another similar type of problem happens from the emerging market perspective as well.
Yeah, and we see actually in Africa, again, there's this notion that there's an unfair risk perception about Africa and a premium about investing in Africa. And the UN last year calculated that this cost African economies 75 billion in higher interest rate payments, or they weren't able to kind of borrow cheaply and hence kind of invest. And so there's a big debate about them at the moment about that kind of unfair, that perception of risk, which is highly problematic, so much so that the African Union are going to create their own credit rating agency next year because there's dissatisfaction with the models and the approach, if you like, of the established three credit rating agencies and how they approach Africa.
Well, that's a space is worth watching. Another theme that seems to be growing in importance is the role of development finance institutions and multilateral development banks in supporting institutional investors to increase their exposure to emerging markets and developing economies. Do you think this is important, and how do you think this can happen?
I think this is absolutely critical. The world faces huge kind of challenges, and we need to address those urgently. And these markets, emerging markets and developing economies, are not just frontiers which offer these investors growth opportunity, but also the benefits of diversifying risk over large portfolios, but they are going to be the battleground where we tackle and address climate change. So money has to flow there. So sustainable investment, which seeks to reconcile return with positive impact on people and planet, has to be the way forward. So we need to make this work. But also there is actually a case financially for these investors to go to these markets. And our recent work analysis of equity and bond indices actually show that performance is just as good as that of equity and developed market bond indices and equity indices over the last 20 years. So, they're leaving money on the table. So there's a strong case in terms of the challenges we face, but also a financial, kind of case. And so, but they find it quite difficult to allocate, if you like. And there are three things, I think, or four things, which MDBs and DFIs can help these investors with. And the first is that there's a very high cost of investing in these kind of markets, mainly because the public markets are not that well developed. And so the investment is concentrated in private assets, which have a very high transaction cost, not very liquid, not necessarily transparent. And so MDBs and DFIs are, the original impact investors in these markets and kind of source this kind of opportunity because they're publicly backed at a lower cost. So they can help with this kind of transaction cost issue. The second issue is, as we just discussed, a lack of familiarity with the markets. But again, these institutions, MDBs and DFIs, have invested in these markets for decades, have this kind of track record, but also benefit, if investors invest with them, they benefit from what we call soft enhancement. So there's something called preferred creditor treatment, for example. So if you like, the DFI or the MDB, if things go a bit wrong, they have a very strong relationship with the government, and quite often their kind of debt or investment is kind of protected or has to be paid first. So these institutions can, if you like, hold these investors' hands. And then the third is that increasing regulation is requiring these investors to increasingly integrate ESG into their investment, but there are issues around kind of data, etc. And these institutions, MDBs and DFIs, have really good due diligence kind of procedures, developed impact frameworks on the ESG. So they're really tight on that. So they can source these assets which meet and tick those data requirement boxes. And then finally, these investors, have a preference for very large ticket sizes, so investment sizes, basically in diversified kind of pools of assets. So these institutions can source the opportunity, but then also structure products which meet the needs of these investments in terms of their risk appetite size.
Interesting. Your recent work, a lot of which is done at the Overseas Development Institute, touches on how ESG, sustainability, and corporate governance regulations can have a potentially disruptive effect on investment in emerging markets. Can you explain a little bit more about why this is and what can be done?
Yeah. So as I mentioned, insurance companies and pension funds and investors more broadly are increasingly expected to integrate sustainability and ESG requirements into their investment decision-making. But in the financing for development discourse, and we talk about billions to trillions or mobilizing private capital, it's equated automatically that that's a positive driver for investment cross-border. But actually, we've seen that it can actually disincentivize investment for a number of reasons. So it's not necessarily kind of a clear-cut direction of travel. And that is because in these countries, they don't have the kind of the ESG frameworks and kind of policy. And so, as I've mentioned before, data is highly problematic. But regulation is intensifying. If we look in Europe, for example, there's the EU Sustainable Finance Package, which is kind of tightening the screws, especially in relation, we've heard about greenwashing, for example. So there's something called the EU taxonomy regulation, which is trying to overcome this issue around greenwashing. So what classifies as a sustainable investment? And so there's something, for example, called a green asset ratio, which basically means the kind of on the numerator, the amount of their portfolio which kind of is labeled as sustainable as a proportion of their total portfolio. So investors can see. The problem is that in that numerator, so how much of their portfolio or the amount that's classified as sustainable excludes any non-EU investment. And so it's underestimating, if you like, the amount of sustainability within that portfolio, which can be a disincentive. So that needs to be kind of like addressed.
That's been fascinating. Thank you so much for being with us, Samantha, and we look forward to continued collaboration with the Development Leadership Dialogue Institute.
Thank you, Jonathan.
Thank you.